Purchase transactions take place when a merchandising company buys inventory, purchases inventory. So there are two different accounting systems for dealing with merchandise transactions. So there's the perpetual inventory system and the periodic inventory system. The perpetual inventory system is what we think of with, for example, Walmart. Every time an item is scanned at the checkout, it automatically updates their inventory records to show one less of that item on the shelf. That differs from the periodic inventory system, which is more like the mom and pop inventory system that you might think of, a small retail store where maybe they key in the price for each item, and it's not like there's a computer system that is perpetually tracking each individual item. So now we'll look at a few examples to help you differentiate between the perpetual system and the periodic system. So the first example says, a company's manager would like to know how many of a certain product is on hand in order to fulfill a large upcoming order. If the manager can pull up a report to show the inventory on hand at any time, what kind of inventory system does the business use? This would be a perpetual inventory system because the manager can pull up a report that shows how many items are on the shelf at that given time. So live data in real time, this is how much inventory the store has. So that's the perpetual system. The next one says, before preparing the balance sheet at year end, a company must count all inventory on hand. To find the cost of merchandise sold, the accountants compare the inventory at the beginning of the year to the amount of inventory counted at the end of the year and purchases during the year. Does the company operate using a perpetual or periodic inventory system? This would be periodic because in order to figure out the cost of goods sold, they have to look at the inventory at the beginning of the year, purchases made during the year, and then the inventory left at the end of the year. So that would be a periodic system because they aren't keeping track in real time of how much inventory is on the shelf. And then the last one, a company records the sales and purchases of merchandise as the transactions occur. The accountant also reviews the totals regularly to check the totals among the journals. So this company also uses a perpetual inventory system. These are the two journal entries. Essentially, it's really just one journal entry, but showing whether they purchased inventory with cash or on account. So you can just see how we record a purchase transaction for inventory. Essentially, you debit inventory and credit cash. Or if it's purchased on account, you credit accounts payable. But obviously, if you're purchasing inventory, you will debit the inventory account because inventory is an asset and you are increasing how much inventory you have. So since that's an asset account, you debit inventory to show an increase. So now sometimes when purchases take place, there are discounts and things like that. So that's what we'll talk about in the next couple of slides. But you find this information on the invoice. So you've probably all seen an invoice at some point. It basically shows the merchandise that is purchased, how much is due, when it's due. So those are called credit terms, meaning how much is owed and over what time period those payments must be made. So the time period is called the credit period. Usually begins with the date shown on the invoice, and for instance, you might have 30 days to pay that amount based on the credit terms. Now, there are also discounts that can be shown on an invoice, and so this is to encourage the buyer to pay that invoice quickly because whoever you are purchasing this inventory from, obviously they want to get paid for that fairly quickly so that they can continue their business cycle, their business operations. So a purchase discount refers to a discount for the buyer. So on an invoice, the credit terms might list, for instance, a 2% discount if the buyer pays within 10 days. So if that's the case, it would be listed as what we call 210, which means 2% if it's paid within 10 days, or the net is due in 30 days. So net due in 30 days. So what that means is that the buyer can get a 2% discount if they pay within 10 days of the invoice date. Otherwise, they have to pay the full amount, and that's due within 30 days. But we pronounce it 210 net 30. This number here will always be the discount amount. So it might not always be 2%. It might be a 1% discount if paid in 15 days, and then the net amount due in 60 days. So just know what the different positions in this mean and know that the numbers could change. But as long as you know what the discount percentage, how that is represented and how many days until the invoice is due, you should be good there. So the discounts taken by the buyer, like we mentioned, are called purchase discounts. So if a discount is incorporated here, that will change our journal entry a little bit. So the buyer will debit inventory for the amount of the invoice less the discount. So the difference with our journal entry here would be, for instance, if $10,000 worth of inventory was purchased, and we'll just say they paid in cash, so they were able to get that discount. So if they purchased $10,000 worth of merchandise, we'll say that they were, with the discount, it ended up only being $9,500. So I'm just throwing these numbers out there. Okay, so if they did not pay within the discount period and they just ended up paying the full price, they would debit inventory and credit cash for $10,000 because that's the full amount. So what's different here when recording the journal entry, if they do take advantage of the discount, the only thing that will change are the numbers here. So they would still debit inventory, credit cash, but the amount in the journal entry will be what they actually paid, including the discount. So there's not like one journal entry to show where they purchased the inventory and then another journal entry to show the discount. You just apply the discount to the total amount, and that is the amount that you record in your journal entry. So here's another example to show that a little more clearly. So in a previous exercise that I don't think I included here, but just know when I refer to exercise 10, this is what happened in that exercise. So on August 2nd, Tools and More purchased $40,000 of inventory from Hammer Supply on account, and the credit terms were 210 net 30. So just know that ahead of time. So now we'll see what we're asked to do here. Assume that Tools and More pays Hammer Supply during the discount period for the purchase in exercise 10. Show the journal entry to record the receipt of the invoice on August 2nd and payment for the merchandise on August 7th. So we're going to record a journal entry to record the receipt of the invoice on August 2nd. So that will be the first journal entry. And then to record payment for the merchandise on August 7th. So if there was $40,000 worth of merchandise, but they tell us that they are taking advantage of the discount, then what we would do is take the $40,000 multiply by 2, which is $800. So that's the amount of the discount. And then subtract the amount of the discount from that total inventory price to give us the amount that the company will actually be paying for the inventory. So this is the amount that will be used in the journal entry to record when the invoice was received. So the invoice is received on August 2nd. They debit inventory and credit accounts payable because they paid on account. And then the amount that is used is what they actually paid for the inventory. So on August 2nd, that journal entry is just recording when they receive the invoice. They receive the invoice, they go ahead and record it in the system. So then it shows as a payable. And then on August 7th, when it's time for them to pay all their bills, cut their checks, whatever they need to do when they're paying this invoice, the journal entry that they record is to debit accounts payable to reduce that balance. Since they're paying on this now, they'll reduce the balance of what needs to be paid, and to credit cash because they're paying that in cash. So in addition to purchase discounts, there are also purchase returns and purchase allowances. So a purchase return is exactly what it sounds like. It's where you purchase merchandise and then for whatever reason you return it. A purchase allowance is a price reduction typically for damaged or defective merchandise. So be sure you understand the difference in those terms. Purchase returns and allowances are typically recorded before the buyer pays the invoice. So for example, if the buyer purchased $10,000 of inventory on account, they would debit inventory and credit accounts payable. And we'll say that was for $10,000. If they then realize that they're going to be returning $1,000 worth of inventory, they would then go back and prepare an additional journal entry to show that, to reflect that returning $1,000 worth of inventory. So what they would do then would be to debit accounts payable and credit inventory for the $1,000 worth that's being returned. So then the same will go for a merchandise allowance or a purchase allowance also. The only difference is that with a purchase allowance, typically this is for damaged or defective inventory, but it works the same way. It will be recorded the same way. So here's an example looking at purchase returns and allowances and how they're recorded. So this goes along with the previous example that we did about exercise 10. So you'll see some of this familiar information. So if Tools and More returns $10,000 of the merchandise purchased from Hammer Supply on August 5th, give the journal entry to record the return of the merchandise, and then also prepare a new journal entry to record the payment on August 2nd after the company's return. So just as a reminder, this is what happened initially. So it was $40,000 worth of merchandise that they purchased, but they had a 2% discount that they took advantage of. So then that ended up being a total of only $39,200. So they received the invoice on August 2nd. Based on the invoice and that discount amount, they debited inventory and credited accounts payable for that amount. So now what we're throwing into the mix is that on August 5th, they are returning some of the merchandise before they pay for it. So this is the journal entry for returning the merchandise. So note that they're returning $10,000 worth of merchandise. But since they got a discount, it's not actually the full $10,000 worth of merchandise. So they actually only paid initially $9,800 for that particular group of merchandise. So anytime a discount is applied when the merchandise is purchased, if any is returned after that, you also have to use that same discount amount to calculate the journal entry, or calculate the amount for the journal entry to show when the merchandise was returned. So if anything is returned, you basically just flip-flop the accounts from when it was purchased. So when it was purchased, debited inventory, credited accounts payable. If you return it, then you're doing the opposite there. So then you will debit accounts payable and credit inventory. And then finally, the last part is to record the payment on August 7th after the company's return. So paying the invoice, that would just be a debit to accounts payable and a credit to cash. So in order to determine how much they ended up actually paying for the merchandise, remember it was initially recorded with the discount, the 2% discount, it was $39,200. Then they returned $9,800 worth. So that gives a total left to be paid of $29,400. So that's how this number was calculated.